Fitch projects another strong year in the U.S. high-yield bond market. Fitch projects high-yield bond issuance to be between $225 and $275 billion in 2013, which represents a slight decrease from where we stand today at $310 billion with 2 weeks remaining in the year. Use of proceeds will be a lot broader in 2013, but continue to be dominated by refinancing activity. Strategic opportunities such as M&A, LBO, and dividend recaps will continue into 2013, but will not be a meaningful portion of the use of proceeds. Over on the demand side, high-yield bond funds are expected to see inflows, but not at the meaningful levels that we've seen in 2012. Year to date, we've seen over $30 billion flow into high-yield bond funds. However, flows will be susceptible to both inflows and outflows and swings based on the events that are taking place in both the U.S. and European market. Moving over to the loan side, Fitch expects a leveraged loan market to have another strong year with issuance between $625 and $675 billion, which would represent a 4 to 6% increase over 2012 levels. Use of proceeds will continue to be dominated by refinancing. However, opportunistic opportunities such as covenant-lite, dividend recap, LBO, and M&A opportunities will continue like we've seen in the second half of 2012. Moving over the demand side, high-yield bond loan funds will continue to see inflows. However, CLO issuance will be the primary driver behind demand. CLO issuance to date has been over $50 billion. In 2013, CLO issuance is projected to be anywhere between $60 and $70 billion. Despite the increase in the number of aggressive deals that have hit the marketplace in 2012, there has been a discipline in the market. Investors have pushed back in a number of instances in 2012, either on structure or pricing, so there is discipline in the marketplace. Leverage may increase in 2013 due to the fact that there's been so much capital in the capital markets, and issuers have been taking advantage of that by issuing high-yield bonds and leveraged loans. However, companies are in a lot better position financially from a balance sheet standpoint and a liquidity standpoint. Issuers are flush with cash. Also, maturities have been pushed out, and interest rates have been lowered by the lower debt that they've been able to issue. Fitch projects the trends that we've seen in 2012 to continue in 2013 from a covenant-lite standpoint. In the month of October, we saw over $20 billion of covenant-lite loans issued. Quarter to date, we've seen over $30 billion of covenant-lite loans issued. And thus far in 2012, we've seen over $65 billion of covenant-lite loans issued, which would represent a 24% increase over 2011's full year total. We do expect the trends that we've seen in 2012 to continue into 2013 as issuers in the BB and high single B category to continue to take advantage of the aggressiveness in the marketplace. The lack of capex spending in 2012 is really not having an impact on high-yield bond issuance. As a percentage of proceeds, capex spending represents around 17% of total issuance, which is consistent from the percentages seen over the last 6 years. Due to the lack of revenue growth opportunities in the marketplace in 2012 and 2013, issuers will continue to look for M&A opportunities to bolster top-line growth, and thus they'll probably direct less of their proceeds toward capex or looking for organic opportunities.